The number flashed across trading screens in London, Tokyo, New York, and Dubai simultaneously, and within minutes it had become the most important number on Earth: $147 per barrel. That's the price of Brent crude oil as of the market open this morning, and it hasn't stopped climbing. To put that in perspective, oil was trading at around $80 per barrel less than 3 weeks ago. That means the price of the world's most essential commodity has nearly doubled in less than a month. That is not a market fluctuation. That is not normal volatility. That is a fundamental repricing of global economic risk, and the implications for ordinary people in every country on Earth are going to be felt within days. But here's what the headline price doesn't fully capture. What's happening in the oil market right now is not just about oil. It's about the economic dimension of the broader conflict in the Persian Gulf. And it's a front in that conflict that is, in some ways, more consequential than the military actions that have dominated the headlines. Because military conflicts, however devastating, tend to be geographically contained. Economic conflicts aren't. They travel. They multiply. They reach into every home, every business, every government budget on Earth. The economic war has begun. Let's talk about what that means, where it's going, and what you need to know right now. Oil prices are determined by a combination of physical supply and demand and market expectations about future supply and demand. In normal times, the physical fundamentals, how much oil is being pumped, how much is being consumed, how much is in storage, drive prices. In abnormal times like right now, market expectations about the future overwhelm the current physical fundamentals. The Persian Gulf region, specifically the waters around the Strait of Hormuz, is the single most important choke point in global energy supply. Every single day, between 17 and 20 million barrels of oil pass through that narrow waterway. That's roughly 1/5 of global oil consumption. Saudi Arabia, Iraq, Kuwait, the UAE, Qatar, all of their oil exports transit the strait. Iranian oil, going to China and the few other buyers willing to trade with Iran despite sanctions, also comes through the strait. And LNG from Qatar, which is the world's largest LNG exporter, also transits through the strait. If that waterway becomes even partially disrupted, if shipping companies start routing around it, if insurance premiums make transit economically prohibitive, if actual military action creates physical damage to tankers, the effect on global energy supply is immediate and severe. And that is exactly what markets are now pricing in. The current spike isn't because oil supplies have actually been disrupted yet. It's because markets are pricing in the probability that they will be. And given everything that's happening militarily and diplomatically in the region, that probability has risen sharply. The Strait of Hormuz is 21 miles wide at its narrowest point, flanked on the north by Iran and on the south by Oman. Ships transiting the strait follow designated traffic lanes that bring them within a few miles of Iranian territory. It's one of the most intensely monitored waterways on Earth, and it's also one of the most dangerous because Iran has spent decades developing the ability to threaten traffic through it. Iran's anti-ship capabilities are extensive and specifically designed for operations in confined littoral waters like the strait. They include fast attack craft, small, fast boats that can carry anti-ship missiles or be used as ramming weapons. They include mines. Iran has vast stocks of sea mines, including some sophisticated enough to identify specific types of vessels and detonate selectively. They include shore-based anti-ship missiles, and they include submarines. Iran has 3 Kilo-class submarines purchased from Russia, and a fleet of domestically produced midget submarines that are well-suited to operations in the shallow waters of the Gulf. The United States Navy is also in the region, and its capabilities significantly exceed Iran's. In a direct confrontation, American naval forces would likely defeat Iranian naval forces decisively. The question is not who would win a naval battle in the strait. The question is what the cost would be. Even a few successful Iranian attacks, a tanker sunk, a mine detonating under a supertanker, a shore-based missile striking a vessel, would be enough to drive shipping companies away from the strait and send insurance premiums into the stratosphere. You don't need to close the strait completely to functionally disrupt it. You just need to make transit sufficiently dangerous and expensive that the global shipping industry voluntarily reroutes. And the routing alternatives are terrible. The next best option is going around the Cape of Good Hope at the southern tip of Africa, which adds roughly 2 to 3 weeks to transit times and dramatically increases the cost of every barrel of oil that would otherwise have gone through the strait. Oil price shocks don't hit every country the same way. America has become a major oil producer, which means it's partly insulated from oil price spikes in a way it wasn't during previous crises. American domestic oil production can partially compensate for supply disruptions. But America is also a major consumer, and gasoline prices will rise. Politically, a gasoline price spike is toxic for any president. Trump knows this better than anyone. A price shock that drives gas above $5 per gallon nationally would create significant political pressure to de-escalate quickly. European countries are far more exposed than America. Europe imports most of its oil, and much of it transits the Strait of Hormuz at some point in the supply chain. European countries also spent years diversifying away from Russian gas after the invasion of Ukraine, and much of that diversification involved LNG imports from Qatar, which comes through the strait. A serious disruption to the strait would hit European energy security at a moment when it's already under strain. Energy poverty, industrial shutdowns, and political instability across Europe are realistic risks if the situation persists. China is arguably the single most exposed major economy to a Strait of Hormuz disruption. China imports roughly 10 million barrels of oil per day, and the vast majority of it comes from the Middle East through the strait. China has some strategic petroleum reserves, but they are finite. A sustained disruption to strait traffic would create energy shortages in China that could slow its economy dramatically. Japan and South Korea import essentially all of their oil, and a very high proportion of it transits the Strait of Hormuz. Japan's entire industrial economy depends on that oil. Both countries have strategic reserves, but like China, those reserves are finite. They can buffer a short disruption, not a long one. And then there are the countries that will suffer most. The developing nations with small economies that can't produce their own energy, can't afford to diversify their supply sources, and have no financial buffer against price spikes. Sub-Saharan Africa, South and Southeast Asia, parts of Latin America. These are the places where an oil price spike of this magnitude translates directly into food insecurity, economic contraction, and political instability. Here's the thing about oil price spikes that doesn't get enough attention. They don't just affect energy, they affect food. Modern agriculture is built on petroleum. Fertilizers are made from natural gas. Farm equipment runs on diesel. Food processing facilities consume enormous quantities of energy. Transportation, getting food from farms to distribution centers to grocery stores, runs on fuel. When oil prices double, food prices follow. Not immediately and not by the same proportion, but the correlation is strong and has been documented through multiple previous oil price shocks. The 2007-2008 oil price spike was a significant contributor to the global food price crisis of the same period, which in turn contributed to political instability in multiple countries. Fertilizer prices are already rising in anticipation of what's coming. Importing regions, particularly in Africa, the Middle East itself, and parts of Asia, are going to face a compounding food and energy crisis that will have serious humanitarian consequences. This is not a theoretical concern. Food and energy crises drive refugee flows. They drive political instability. They create the conditions in which extremist movements recruit successfully. The secondary effects of this economic shock could be generating conflicts and crises in countries that have nothing directly to do with the Iran situation. And those downstream effects could persist for years after the immediate military situation is resolved. Financial markets, whatever their moral limitations, are extraordinarily efficient processing machines for information about probable futures. The way markets are behaving right now tells you things that no single analyst can tell you. Gold is trading above $3,000 per ounce, signaling that investors are seeking refuge from a system that feels fundamentally unstable. It's not just about this specific conflict. It's about accumulated uncertainty, accumulated distrust of fiat currencies, accumulated concern about the sustainability of global debt levels. The oil shock is the immediate trigger, but the gold price reflects deeper anxieties. Defense stocks are surging. Conflict means contracts. Contracts mean revenue. Revenue means profit. Shipping stocks are having a complicated week. On one hand, reduced supply of vessels willing to transit the Gulf means higher rates for those that do. On the other hand, the risk of physical damage to vessels, the cost of war risk insurance, and the operational complexity of alternative routing creates costs that partially offset the revenue gains. Bond markets are showing something important. The spread between American Treasury yields and yields on sovereign debt from major oil-importing emerging market economies is widening, one of the early indicators of international financial contagion that could develop if the oil price shock is sustained. Currency markets show the classic safe haven dynamics. The dollar is strong, the yen is strong, the Swiss franc is strong. Currencies of major oil-importing emerging market economies are under significant pressure. Weaker currencies make imported oil more expensive in local terms, compounding the inflationary effect of the global oil price rise and threatening debt sustainability in countries that have borrowed heavily in dollars. When oil prices spike, governments have one primary short-term tool at their disposal: strategic petroleum reserves. The United States has the Strategic Petroleum Reserve, the world's largest government-owned emergency crude oil stockpile. At its peak, it held over 700 million barrels. The Trump administration has signaled it's considering a coordinated release with allies, meaning coordinated drawdowns from American, European, Japanese, and South Korean reserves simultaneously to flood the market with extra supply and push prices down. Does this work? In the short term, yes. Coordinated reserve releases have successfully dampened oil price spikes in the past. The effect is typically a $10 to $20 per barrel reduction that lasts for several weeks. But strategic reserves are, by definition, finite. You can release oil from reserves to buffer a short disruption. You cannot sustain reserve releases indefinitely if the underlying supply disruption continues. The reserves buy time. They don't solve the problem. OPEC's response to a strategic reserve release is critical. If OPEC decides to cut production to offset the release, keeping prices elevated despite the additional government supply, the reserve release strategy fails. Saudi Arabia has done exactly this in the past. Whether it would do so now, in a conflict where Saudi Arabia itself feels threatened by Iranian aggression, is uncertain. The honest answer is that if the Strait of Hormuz is seriously disrupted for more than a few weeks, no combination of reserve releases and alternative supply increases can fully compensate. The global economy would enter a sustained period of elevated energy costs that would dampen growth, raise inflation, and create political pressure in virtually every country on Earth. Energy price shocks have political consequences. History demonstrates this repeatedly and consistently. The 1973 Arab oil embargo created fuel shortages, long lines at gas stations, and economic pain that contributed directly to the political upheaval of the mid-1970s in the United States and Europe. It also accelerated inflation that the Federal Reserve ultimately had to break with an extremely painful period of high interest rates. The 1979 oil shock, triggered by the Iranian Revolution, was a significant contributor to the stagflation crisis of the late 1970s and early 1980s. It brought Jimmy Carter's presidency to its practical end and set the conditions for Ronald Reagan's landslide victory in 1980. The point is not that history repeats. The point is that energy price shocks create real economic pain for ordinary people, and ordinary people in democracies vote for political change when they're in pain. Trump is acutely aware of gas prices and their political significance. His advisors are aware that a sustained oil price spike that drives American gasoline prices to record levels would be politically devastating. This creates pressure to de-escalate, Not because Trump wants to look weak, but because he wants to win in 2026 and beyond. The political economy of oil prices may ultimately be a more powerful driver of American decision-making than any military calculation. Conversely, Iran's leadership understands this dynamic perfectly. The oil price spike is not just an incidental consequence of the conflict, it is a strategic asset. Every dollar that oil prices rise is a dollar of economic and political pressure on Trump to find a way out of the confrontation. Iran's willingness to threaten Strait disruption, even without fully implementing it, creates leverage that pure military power cannot match. There is an ironic dimension to the current oil price crisis that deserves acknowledgement. Oil price spikes historically accelerate the transition to alternative energy sources. The 1970s oil shocks drove enormous investment in energy efficiency, nuclear power, and early renewable energy research. The 2000s oil price run-up drove the investment boom that made American shale oil economically viable and turned America into a net energy exporter. High oil prices make alternatives economically attractive in ways that low oil prices suppress. At $147 per barrel, solar energy is decisively cheaper than new oil-based electricity generation in most parts of the world. Electric vehicles become dramatically more cost-effective relative to internal combustion vehicles. Heat pumps become more attractive relative to gas heating. Investment in alternative energy will accelerate, driven not by policy preference but by economic logic. The cruel irony is that the countries that will most benefit from an accelerated energy transition, the oil-importing developing countries that are now being devastated by the price spike, are also the countries least capable of making the investments required to transition quickly. The economic war is real, it's happening now, and it's going to be felt by hundreds of millions of people, in their gas tanks, in their grocery bills, in their heating costs, in their job prospects, before the underlying military and political conflict is resolved. The oil market is telling you something that the political rhetoric often obscures. The costs of this conflict are not theoretical. They're not distant. They're immediate, measurable, and falling on ordinary people who have no say in the decisions that created this crisis. What happens next in the oil market depends on what happens in the Persian Gulf militarily and diplomatically. Those who tell you they know exactly what's coming are guessing. What we can say with confidence is that every day this situation persists, the economic costs mount. And eventually, those economic costs create their own pressure toward resolution. Or, if the pressure is mismanaged, toward a different kind of escalation. The economic war has begun, and it will not end cleanly or quickly. But the side that understands it best, that uses the economic dimension of this conflict most strategically, will have an advantage that pure military power cannot fully compensate for. Stay tuned. The price on the ticker is not just a number. It's a message from the market about the state of the world. Right now, the message is loud, clear, and alarming.